Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions as a point of reference to you, the viewer. We expect you to make your own financial decisions. Today is Sunday, July 5th, 2021, and this is Blockhead Traders Weekly. This week, it's just myself, Sprocket888, and I'd like to take a little bit of time to go over a recent trade of mine that went horribly wrong. It was a trade on soy futures, and it ended up a maximum loser for myself and took a big hit in my July monthly performance, and I'd just like to review the trade over with you. But before we get to that, I want to give a shout out to our Discord channel. I want to let you know that we do run a free Discord channel where you can join. There's a link in the description below. You can hop in there, say hello to us, interact with some of the other Blockhead traders out there. It's a good community, rapidly growing. Love to have you drop in and say hi. So let's take a look at the soy trade that went terribly wrong. So this trade was done on futures contracts of soy. So that is the /ZS ticker. On June 9th, I was looking at the July expiration of soy. I believe it was probably in the 45 days to expiration range at that time. And I decided to sell a 1490 put. So at the date that I sold it, that 1490 put was about a 35 delta. So I suppose this was probably the first sign that things might be off to a rough start. If you recall, most of the premium that I always sell is usually between a 16 and 30 delta on the most aggressive trade. Usually 30 delta is about where I stop. In this particular case, I was overly confident, I believe, and I actually bumped up to the 35 delta to get just a tiny little bit more premium out of it. Unfortunately, by June 17th, the buying power reduction and margin expansion on the trade just exceeded what I was capable of holding from my risk tolerance perspective, and I basically closed the trade out on June 17th. When I bought the put back, it basically was 5.79 times what I ended up originally selling it for. So the net cash impact to my portfolio was about an $8,500 loss. This largely negated all of my gains for my contracts in the month of July. This is probably up there with one of my largest lost trades. I'm going to go through some of the anatomy of this, but so far I've probably been trading for, I would say, about 18 months with this current strategy that I have. And this is probably the third or fourth time where I closed a position on the grounds that it basically exceeded my risk threshold. So you'll see in some of the slides, this also breached my bailout price. So one thing that we talk all the time on Blockhead Traders is about knowing your exit plan, know your bailout price, know why you entered a trade, and when your trade thesis no longer is correct, or it's showing that you might not have been right, don't be afraid to exit. And actually, this episode is all about me doing exactly not that thing. So let this be a lesson to you guys to see what can go wrong when you kind of ignore a lot of the rules that you had laid out in your trades. So let's take a look here. I took a snapshot of the price action from when I entered the trade to when I exited the trade. Let's take a look at that here. You can see that this is a beautiful graph of exactly what not to do. I sold here. When I sell SOL, I was short the position, so I basically collected the premium here at this level. About 1,600 was the trading price, and it basically traded against me the entire time. And this little flag here is where I actually ended up closing. If you pay attention, there's a tiny little red candle down here. This is where I got out. And naturally, you can see that I basically did exactly the worst thing you could do. So I entered up here. It did nothing but drop, 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 drop. And then when I finally exited the trade, we got a little bit of a rebound, but you'll see in the following kind of anatomy that this little rebound really wouldn't have saved me much at all. So you might be wondering what went wrong. And to really understand what went wrong, I kind of took a couple of different charts here. The first chart will show you what the trade setup looked like and what I was thinking. And the next chart that's right next to it will show you all the things that went wrong and the warning signs that I ignored. So fundamentally, the reason that this trade ended as bad as it did was I ignored my rules. I did not follow my exit plan, and there were 2 warning symbols prior to that that I basically did not pay attention to. I knew they were there, but I chose to ignore them thinking it'll work out. It'll work out. So the first thing I want to call out here is this chart with the green arrows. This was what I was looking at prior to entering the trade. So you can't really see it on here, but I ended up entering maybe 3 or 4 candles after this green touch point here. But the key point is multiple times in this rally of soy, it basically would dip down to about the 50-day moving average and then kind of deflect off of it. Now, it might go a little bit below the 50-day moving average, but it never stayed there for an entire trading day. So you can see here, we went below the line. So the green line here, this is the 21-day moving average. The yellow line is the 50-day moving average. And this kind of orange line is the 100-day moving average. And I was using the exponential moving averages, which basically take a little bit of volume weighting. And this is something I traditionally look at whenever I take a setup of a trade, is I look to see how the particular underlying reacts to the different moving averages. And part of that is my assumption is when I enter the trade that same behavior is likely to repeat again. And so when I see something like this coming down and kind of touching that 50-day moving average and then bouncing back up and touching it and bouncing back up, when this trade comes down to about that 50-day moving average, that's when I'll say, hey, this is likely going to deflect off the 50-day moving average. So before it starts to turn around, I'll go out and sell a 16 to 30 delta put against it, which of course will be significantly below that moving average. And in this particular case, it had already come off that 50-day moving average and was probably about up here around the 21-day moving average, maybe a little bit higher when I actually started this trade. And what happened after that, so here, this tiny little gap area here, I probably should have called it out again to remind you, this is actually where I entered the trade. So this is zoomed in. So these candles are hourly candles, just to give a little bit more granularity because this trade was pretty short-lived. Remember, it was just like June, 9th to the 17th. And so I entered it here. Initially, started losing ground. Didn't really get worried at all because my bailout strike was down here at the 1435 line. So this white line is my bailout point of where I should pull the ripcord according to my rules and exit the trade. So the first warning was we breached this 50-day moving average. So right here, this yellow line is the 50-day moving average. We crashed through it. Now, this is hourly, so there's a couple candles that happened in there, but it stayed there for a day and 2 days, actually. It never came back above that 50-day moving average. So this should have been one of the first warning signs. Now, this breach is really not a exit plan for me, but I should have taken this signal more seriously. And what I mean by that is, if you remember, my thesis was we're going to come down and hit the 50-day and bounce, 50-day and bounce, 50-day and bounce. We broke that trend here. So we came down to the 50-day and we did not bounce. So this is kind of warning sign number 1. Now, warning 2 and 3 happened almost simultaneously. maybe a day apart from each other. Warning two is basically we breached the 100-day moving average. Now, even approaching the 100-day moving average really should have been a significant warning sign that I should have heeded. If you go back to why I entered the trade, you can see how far away this underlying is from that 100-day moving average. Now, here's where it touched it. This is when I was actually already in the trade. But even approaching this should have been major red flags for me. But I guess I had too many winners, and I thought, it'll come around. It'll come around. And I'm relatively new to futures, and so in the back of my head, I was telling myself, maybe you just don't understand futures. It's probably okay. And I stayed in the trade. So then warning three came out, and this really is the inexcusable part of this particular trade. We breached the 1435 bailout price, and not only did we breach it, we gapped it big. So on this particular day, it actually opened up, gap down, significant gap down, and this gap down open was below my bailout price. So this really, by my rules, should have been my exit point. But I can tell you that when you're in these trades, they feel terrible to exit. And I just got caught up in it, and I traded emotionally, not mechanically. And I thought, it'll come back around. It'll come back around. And then this trading day proceeded to just go down and down. And you can't really see it on here, but there was a 1 hour candle that was just massive. Now, I was already in quite a bit of pain, but after this 1 hour candle, I basically kind of came to my senses somewhat and basically said, look, what are you doing? You're ignoring your rules. You're still in this trade. You need to get out. There is no indication that this is going to get better. In fact, it's more likely to get worse before it gets better. We've broken the trend that had been set, the purpose of the setup. And so actually I exited, ironically, at the worst position in this particular calendar, right here in the bottom of this. I would add that I didn't know that was going to be the worst place, and I really should have stuck to my rules and exited much higher. It still would have been a loser for me, but it would have been a significantly smaller loser. It still would have hurt, but it probably wouldn't have hurt as much as where I exited. And I just want to let this be a lesson to you, the viewer. As much as it hurts to exit according to your rules, and I don't know how to say this other than you think that it's going to be easy to trade mechanically, but when you're looking at it and you're looking at this large loss, even at this point, at my bailout price breach, there's a big part of you that just doesn't want to come to the realization and admit that particular loss. And in my case, I ignored it and I stayed in the trade. And I can guarantee you that the pain I felt down here where I finally closed the position out was significantly worse than the pain I was feeling earlier. So yeah, these are basically the three warning signs. One completely inexcusable that I didn't follow. And I'd like to just kind of chat on the next slide here about this bailout price setting. And I'm not making excuses for kind of ignoring that bailout price. This is more talking about why the first two warning signs were ignored, not so much the bailout price. I'm going to pull up an actual chart to visualize what I'm actually talking about here. So that should help. But essentially my bailout price rules, and this goes for every short strategy that I deploy. So whether it's a put side, a call side, doesn't matter. I take the premium that I collect on the trade, means when I open the trade up, whatever premium I collect, I multiply that premium by 3. And I then take that away from the strike price of the trade I opened up. So in this particular case, the strike price I opened up was $14.90. The premium that I collected was $17.75. So 3 times $17.75 is 54 something or other. And so basically I take $14.90 minus 3 times that premium, and that's my bailout price. And if it was the call side, I'd have added it to the strike of the call. And what that does in the setting is I use the price of the option at expiration. Now, you can consider this a weakness. It is something you need to be aware of, and I'll show you that in the chart here in just a second. But when I use the price at expiration, there's still a lot of extrinsic value in those options. So the sooner you hit bailout prices means the farther away from expiration you are when you hit your bailout price, the more extrinsic value that's going to be in there, and the loss could potentially be larger than you were accounting for. Now, the flip side of that would be to set your bailout price off of the option's current price. And the drawback there is you could potentially bail out too soon before the statistics and law of probabilities or law of large numbers actually works out in your favor. And I'm going to show you these two lines on a chart, which will help a lot. Now, futures, and I'm new to this a little bit, options on futures, they seem to have a lot more extrinsic value in them. And in this particular soy case, the soy was crashing hard, so volatility was expanding rapidly. So the distance between the value of those options at expiration and the value of those options on that particular day was pretty wide. So not only did I end up well below the price where I should have, there was a significant other penalty that I paid because there was still a lot of extrinsic value left in those options because we were so far away from expiration. Okay, so let's go take a look on a P&L chart, and let me show what I'm talking about here in some of these differences in how the extrinsic value manifests itself. So right here, I have the option chain for soy futures, options on soy futures. And I'm going to stick with the strike that I have here of 1270. I got that from the option chain in September, about 53 days away. I'm going to stick with 1270 because the markets are actually closed right now. And some of this will look really weird based on the bid-ask spread that's sitting here. Some of these are really, really wide, and that's just because the market's closed right now. So these happen to be the closing numbers from the last time before the futures market was actually open. So the 1270 is a 16 delta, which is something I would probably sell anyway. But we're going to stick with that and not change it because this spread here, well, it's a little bit wide. It's not terribly wide, so it'll still work out in the example I want to show you. So right here we have the trade that I would put on. So to set my bailout price, the way that I do that is I look at this orange line. This orange line is the premium I'm collecting. So 681. So the first thing I would do is I would say, okay, 681, that's 1362 loss that I'm looking for as my bailout price. And so I just use this cursor. I just kind of slide across here until over here in this corner, my 828, that's at expiration, would yield about 1360 in loss. So looks like right here at 1229.25. So let's call it 1230. So 1230 is actually my bailout price. So I'll move my price slice down here to 1230. Now, the purple line is the option price today as of July 5th. So you can see right here, if the bid ask was a little bit tighter, this purple line should be intersecting the 0 point right now. It's kind of close. It's a little bit off, but we're just going to roll with it. So what I mean by this is when this thing slides down initially, if it comes down fast, this gap between this orange line, red line, and this purple line, this distance is basically the extrinsic value in the option. So while I want my bailout price to be 2 times my credit received, if I set that at expiration and we rapidly approach this number of 1230, you can see if I actually tried to close out when we were at 1230, I would actually be paying way down here. So my actual loss, instead of being 1360, would likely be in nearly 3,300 because of the extrinsic value left in the option. And so one of the factors in soy was we declined so fast initially that this extrinsic value didn't really get to come out of the option. It did to some extent, but that was overshadowed by the amount of extrinsic value that was coming into the option because volatility was going way up as the price was crashing down. Now, you can see the drawback to the flip side is say, well, why don't you just close out as soon as your loss to close the position out reaches the 1360 threshold that you have for yourself? And the answer is, if you look at the purple line, let's look at the purple line on when that thing hits my threshold of 1360. Okay, that's at 1310. Well, that is almost 100 points, maybe 70 points above my actual strike price. So that's kind of too early. And so when I do my strategy, I always set my bailout price at expiration. However, the one caveat to that is it can be very bad if you approach your bailout price very early on in the trade, means with significant distance to expiration. Now, I will add that in futures, this seems to be much, much worse and much larger of an impact than in regular equities. So in regular equities, I never see this much distance between the price at expiration and the price today when you're going down to this particular bailout price. So, this is something I'm definitely looking into when it comes to my futures option trades, because this one really did bite me hard. But I'll go back to the point that I mentioned is the real reason this one ended up just really, really bad is I ignored my most important rule, and that is the breach of my bailout price. So if you recall, if I'd exited here, I'd have been in a much less of a loss than when I exited here at the bottom. So that brings us to the end of this week's episode. Not a particularly amazing episode from my point of view. However, I definitely think it is important that when people put videos out on YouTube for people to learn from, you got to take the bad with the good. And this is, like I said, probably one of my worst performing trades in the amount of time that I've been doing these trades. Like I mentioned a little bit earlier in the video, this is about the third or fourth time in which a bailout price was actually hit and breached. And I basically took what would have been the max loss on the trade. And really, one of the key reasons I didn't follow my rules. And so we talk all the time on here to trade mechanically, trade without emotion. It might sound easy when you listen to us, but in practice, this is a very hard thing to do, and to do it with consistency and all the time without fail. Because when you're losing, it doesn't feel good. and you want to believe that your trade's going to come back and your trade is going to be a winner, or maybe if you're lucky, close it out for a scratch. In this particular case, you know, I took the loss. I took a loss that was bigger than I probably should have taken. The key point here, though, is I did have my position size correct. So when I actually entered this position, it was sized appropriately. Now, where I exited, it wasn't the appropriate exit size. So that hurt a little more than normal. But the reason that position sizing is so important is because it doesn't matter what you think you know. It doesn't matter what chart analysis you've done. It doesn't matter what information you have. It's a coin flip. These trades could work out. These trades could work against you. And your best defense is your exit plan and your position size. So that statistically, with the deltas that I play, I should come out statistically winning about 75% of the time. And it's that other percent of the time that I need to keep those losses controlled and the position size correct, such that those losses don't outweigh or don't negate the gains from the rest of my winning positions. In this particular case, I didn't exit where I should have. The loss ended up being larger than it should have. And for the most part, it negated all the gains that I had in the month of July. I essentially will close out the month of July as a scratch. So that's good. I'm still in the game. You'll hear me talk about trading is really an infinite game and capital preservation. And as long as you can keep playing, that should be considered a victory. There is no finite end to trading. So you basically have to stay in the game to keep the rewards coming from the risks that you take. So I hope you guys enjoyed this. I hope you guys can see that, hey, we make mistakes here. We don't trade perfectly. We even make the mistakes that we tell you guys all not to make. Just let this be a lesson to you. Let this be an example that, trade mechanically, follow your rules, and don't let your emotions get in there. So good luck this week. Happy trading, and we'll talk to you soon. And remember, think outside the block.